Have you ever wondered why the IRS might decide to audit your tax return? It's a question that can cause anxiety for many taxpayers. In this video, we'll break down the most common reasons the IRS selects certain returns for closer examination. Understanding these triggers can help you avoid mistakes and reduce your chances of being audited. We'll cover everything from simple math errors to more complex red flags, so you'll know exactly what to watch out for when filing your taxes. Let's start by exploring what an IRS audit actually is and why it happens. An IRS audit is essentially a review of your tax return to ensure all information is accurate and complete. The IRS uses audits to verify that taxpayers are reporting their income, deductions, and credits correctly. Audits can be conducted by mail or in person, depending on the complexity of the issue. While the word audit sounds intimidating, most are routine and simply require you to provide additional documentation. Now, let's look at the main reasons why your return might catch the IRS's attention. Sometimes, an IRS audit isn't triggered by anything you did wrong. The IRS uses computer algorithms to randomly select a certain number of returns for audit each year. This process is similar to a lottery, and it helps the IRS maintain overall tax compliance. If your return is chosen at random, it doesn't mean you made a mistake or are suspected of wrongdoing. It's simply part of the IRS's quality control measures. However, there are other, more specific reasons your return could be flagged. The IRS uses a system called the Discriminant Information Function, or DIF, to screen tax returns. This computer program assigns a score to each return based on how much it deviates from the average return in similar categories. If your return has unusual entries or numbers that stand out, it may receive a high DIF score, increasing the chance of an audit. The system is designed to spot inconsistencies or anomalies that could indicate errors or potential fraud. Simple math errors are one of the most common reasons the IRS may take a closer look at your return. Even a small mistake in addition or subtraction can cause your numbers to not match up with what the IRS expects. These errors can trigger an automatic review or even an audit, especially if they affect your total income, deductions, or credits. Double-checking your calculations before submitting your return can help you avoid this common pitfall. Failing to report all of your income is a major red flag for the IRS. The agency receives copies of your W-2 seconds, 1099s, and other income statements directly from employers and financial institutions. If the income you report doesn't match what the IRS has on file, your return is likely to be flagged for review. This is especially important for freelancers, gig workers, and anyone with multiple income sources. Always make sure to include all income on your tax return. Claiming deductions that are unusually large compared to your reported income can draw the IRS's attention. For example, if you earn $40,000 but claim $20,000 in charitable donations, that's likely to stand out. The IRS compares your deductions to averages for taxpayers in similar situations. If your deductions are much higher than normal, you may be asked to provide documentation to support your claims. Self-employed individuals and small business owners are more likely to be audited, especially if they report frequent losses. The IRS knows that some taxpayers may try to use a business to offset personal expenses or reduce taxable income. If you claim business losses year after year, or if your expenses seem excessive, the IRS may want to take a closer look. Keeping thorough records and separating personal and business expenses is crucial. The home office deduction is a legitimate tax break, but it's often misused. Claiming a home office requires that the space is used regularly and exclusively for business. If your deduction seems too large, or if you claim a home office without clear justification, the IRS may investigate further. Be sure to keep detailed records, including photos and floor plans, to prove your claim if needed. Charitable donations are a great way to reduce your taxable income, but claiming amounts that are unusually high for your income level can raise suspicion. The IRS compares your donations to those of other taxpayers in similar situations. If your donations seem out of line, you may be asked to provide receipts or other proof. Always keep documentation for any charitable contributions you claim. Claiming dependents on your tax return can provide valuable tax breaks, but the IRS checks to make sure each dependent is eligible. If you claim a dependent who is also claimed by someone else, or if the information doesn't match IRS records, your return may be flagged. Make sure you have the correct Social Security numbers and meet all requirements before listing dependents. The Earned Income Tax Credit is a valuable benefit for low and moderate income workers, but it's also a common target for audits. The IRS pays close attention to EITC claims because they are sometimes claimed incorrectly. If you claim the EITC, be prepared to provide proof of your income and qualifying children. Double-check all information to ensure you meet the requirements. The IRS matches the information you report on your tax return with data from employers, banks, and other sources. If there's a mismatch, such as a missing W-2 or incorrect Social Security number, your return may be flagged for review. Always double-check that all information matches your official documents before filing. Taxpayers with higher incomes are more likely to be audited. The IRS focuses more resources on returns with larger amounts of income because the potential for errors or fraud is greater. If you earn over $200,000, your chances of being audited increase significantly. However, most high-income audits are still routine and simply require additional documentation. If you have foreign bank accounts or assets, the IRS requires you to report them. Failing to disclose foreign income or accounts can lead to an audit and significant penalties. The IRS receives information from foreign banks and governments, so it's important to be transparent about any overseas holdings. Make sure to file the necessary forms, such as the FBAR or FATCA, if required. Large cash transactions, such as deposits or business sales, can attract IRS attention. Banks and businesses are required to report cash transactions over $10,000. If your return shows large amounts of cash income or expenses, the IRS may want to verify the source and legitimacy. Always keep records of any large cash dealings to support your tax return. Using round numbers or estimates on your tax return can look suspicious to the IRS. For example, reporting $5,000 in expenses instead of the actual amount suggests you may not have accurate records. The IRS prefers to see precise figures, so always use exact amounts from your receipts and documents. Avoid rounding unless it's absolutely necessary. Filing an amended return to correct mistakes is perfectly legal, but it can also increase your chances of an audit. The IRS may review both your original and amended returns to ensure all changes are legitimate. If you need to file an amendment, make sure to include clear explanations and supporting documentation for any changes you make. Transactions with family members or related parties can be legitimate, but they often receive extra scrutiny from the IRS. This is because such transactions can be used to shift income or deductions inappropriately. If you have business dealings with relatives, make sure all transactions are at fair market value and properly documented. Withdrawing money from retirement accounts before age 59 and a half can trigger taxes and penalties. If you report early withdrawals, the IRS will check to make sure you've included the correct penalties and taxes. Failing to report these amounts accurately can result in an audit. Always review the rules for retirement account withdrawals and report them correctly. If you pay or receive alimony, both parties must report it correctly on their tax returns. The IRS matches alimony payments claimed as deductions with the income reported by the recipient. If the numbers don't match, both returns may be flagged for review. Make sure you and your former spouse are on the same page about the amounts reported. Reporting losses from rental properties is common, but excessive or repeated losses can draw IRS scrutiny. The IRS wants to ensure that your rental activity is a real business and not just a way to offset other income. Keep thorough records of all rental income and expenses, and be prepared to show that your rental is operated for profit. Claiming large automobile or travel expenses for business can be a red flag, especially if the amounts seem excessive for your type of work. The IRS may ask for mileage logs, receipts, and explanations for any travel deductions. Only claim expenses that are directly related to your business and keep all supporting documentation. Businesses that primarily deal in cash, such as restaurants or salons, are more likely to be audited. The IRS knows that cash transactions are harder to track and more susceptible to underreporting. If you run a cash-based business, keep meticulous records of all sales and expenses, and consider using a point-of-sale system to document transactions. Bartering and other forms of non-cash income must be reported on your tax return. The IRS may audit returns that show signs of unreported barter transactions, especially if you're in an industry where bartering is common. Make sure to keep records of any goods or services exchanged and report their fair market value as income. Claiming that a vehicle or other asset is used 100% for business is rare and can raise suspicion. The IRS knows that most people use their vehicles for both personal and business purposes. If you claim full business use, be prepared to provide detailed logs and proof that the asset is not used for personal reasons. Claiming tax credits that are uncommon for your situation can trigger an audit. For example, if you claim education credits without having any dependents in school, the IRS may question your eligibility. Always make sure you meet all requirements for any credits you claim and keep supporting documentation. Choosing the wrong filing status, such as head of household when you don't qualify, can result in an audit. The IRS checks your status against the information you provide about your household and dependents. Make sure you understand the requirements for each filing status and select the one that accurately reflects your situation. Certain tax situations require additional forms, such as reporting stock sales or claiming specific deductions. If you forget to include a required form, the IRS may flag your return for review. Always check which forms are needed for your situation and make sure they are complete and accurate before filing. Claiming a large refund, especially if it's much bigger than in previous years, can attract IRS attention. The agency wants to make sure the refund is legitimate and not the result of errors or fraud. If you're expecting a large refund, double-check your calculations and be prepared to explain any significant changes from prior years. Significant fluctuations in your reported income from year to year can raise questions. The IRS may want to know why your income dropped or increased dramatically. If you have a valid reason, such as a job change or business expansion, keep documentation to support the change. Investing in tax shelters or other complex financial products can increase your audit risk. The IRS closely monitors these arrangements to ensure they are not being used to evade taxes. If you participate in any tax shelter, make sure you fully understand the rules and keep all necessary documentation. Using a tax preparer who is known for aggressive or questionable practices can increase your audit risk. The IRS keeps track of preparers with high error rates or suspicious filings. Always choose a reputable tax professional and review your return carefully before submitting it. If the IRS suspects identity theft or fraudulent activity, your return may be audited or held for further review. This can happen if someone else files a return using your social security number or if your information doesn't match IRS records. Protect your personal information and report any suspected fraud immediately. Most IRS audits are conducted by mail, known as correspondence audits. The IRS will send you a letter requesting additional information or clarification about specific items on your return. Respond promptly and provide all requested documents to resolve the issue quickly. Ignoring these letters can escalate the situation. In some cases, the IRS may conduct an in-person audit, either at your home, business, or an IRS office. These audits are more detailed and usually involve a thorough review of your records. If you're selected for a field or office audit, organize your documents and consider consulting a tax professional for assistance. If you're audited, don't panic. The best approach is to respond promptly and provide all requested information. Stay organized, keep copies of everything you send, and communicate clearly with the IRS. If you disagree with the audit findings, you have the right to appeal. Professional help can make the process smoother. One of the best ways to avoid problems with the IRS is to keep thorough and accurate records. Save all receipts, invoices, and supporting documents for at least 3 years. Good record keeping makes it easier to answer any questions and prove your claims if you're audited. To reduce your chances of being audited, avoid common mistakes like math errors, unreported income, and unsupported deductions. Double-check all information before filing and make sure you have documentation for every claim. If you're unsure about something, consult a tax professional. Using reputable tax software can help catch errors and ensure your return is complete. Many programs check for missing information and perform calculations automatically. However, it's still important to review your return carefully before submitting it, as software can't catch every mistake. If you're audited, remember that you have rights as a taxpayer. You have the right to know why you're being audited, to receive clear explanations, and to appeal any decisions you disagree with. The IRS must treat you fairly and respect your privacy throughout the process. Generally, you should keep tax records for at least 3 years from the date you file your return. However, if you underreport income by more than 25%, the IRS can audit you for up to 6 years. In cases of fraud, there is no time limit. Keeping records longer can provide extra peace of mind. Most audits end with the IRS accepting your explanation or making minor adjustments. In some cases, you may owe additional taxes, interest, or penalties. Rarely, audits result in criminal charges. The key is to cooperate fully and provide all requested information to resolve the audit quickly. If you are audited, use the experience as a learning opportunity. Review what triggered the audit and take steps to avoid similar issues in the future. Improving your record keeping and understanding tax rules can help you file more accurate returns going forward. In summary, the IRS audits tax returns for a variety of reasons, from simple errors to more complex red flags. By understanding what triggers an audit and taking steps to file an accurate return, you can reduce your risk and handle any audit with confidence. Remember to keep good records, double-check your information, and seek professional help if needed. Thanks for watching, and best of luck with your taxes.